Hello, hello. Maybe we can show the slides. Amazing. So up next, we have our next slideshow and our next speaker. This time a bit different focus, so it's about cost efficiency measures. I mean, we're not just trying to raise VC money and blow through it, right? But also show some sensible applications and how blockchain and DLT technologies are actually relevant and also helpful to improve business processes, people's livelihood, and so on. That's a very relevant talk for that specific one. So if you're interested in how to make full use of DLT tech in your applications, in your business contexts, at work, whatever it is, pay attention and please come on stage.
All right. So we do a little sound check. Can you hear me? Okay, great. All right. So we had a little technical difficulties. I'm sorry, but we solved them. So welcome and hello. My name is Marius Bauer. I'm a partner and managing director of FinPlanet. For those of you who don't know us yet, we are a DLT consulting boutique focusing on building DLT-based business models for banks and asset managers and also fintechs. So today we're going to talk about cost-saving potential of using DLT across the value chain for ordinary securities, such as a bond, a stock, or a fund. And we're going to do that using a concrete corporate bond as an example. All right, so we did a pricing study about this together with Cashlink. As many of you know, Cashlink is the leading tokenization company in Germany, and also with colleagues from Porsche Consulting. All right. Yeah. So, what was the motivation for doing this study? When we sat together about 18 months ago, we started this pricing study. We kind of contemplated about the fact that everyone's talking about DLT making things more efficient, especially also in terms of the ordinary securities, but no one really could tell us how much. There was very little viable data available, and so we thought, if you cannot make a concrete statement about the advantages of a new technology, using this use case about ordinary on-chain securities and trying to move them on-chain, then you have to make the case for the real advantages. Otherwise, there's no reason for you to apply that new technology. So that was kind of the motivation for us to shed some light on this topic and to try to come up with a credible and viable quantification of the actual cost-saving potential of moving such a security, as I mentioned, this corporate bond on-chain. So we basically, in other words, we're looking for the cost-saving and efficiency potential of a concrete corporate bond being moved to the blockchain. All right. So to start with the management summary first, I think there were three main takeaways from our study. And the first one was that we calculated a efficiency and cost advantage of moving this corporate bond that we investigated on the blockchain between 7 and 15 basis points. Now you can say from the perspective of the end consumer or the end customer, 5 to 7 basis points is virtually nothing, and it's not very spectacular. But when you look at it from the perspective, let's say, from a large asset manager, and you're looking at 200, 300, 400, 500 billion assets under management, then you're talking about real money here. Secondly, we discovered that virtually all of the DLT cost savings potential that we discovered was in the middle and back office processes. So in other words, we did not find any cost saving potential in the front office, at least none that were directly related to DLT. And thirdly, we found that the results of our study were very sensitive to the actual maturity level of the DLT infrastructure. And what I mean by that, we're gonna dig a little deeper in the following slides. And also, we discovered that the results were quite sensitive whether or not you incorporate foreign or domestic investors. And that's not because the on-chain costs, it would make any difference for the on-chain costs because the blockchain doesn't care about borders, but it does make a big difference when you consider the cost basis, the off-chain cost basis. There it makes a lot of difference, and that's why we found different results there. All right, so let's dig a little deeper here, and moving on to the assumptions and the methodology. As I already mentioned, we discovered that the results were very sensitive to the infrastructure maturity level, and that's why we were looking at 3 different points in time, and each point in time basically depicts a different level of DLT infrastructure maturity. So we could actually have a means to measure the effect of changing infrastructure maturity. What is that? First of all, we looked at today's on and off-chain costs, and then we created a 2026 scenario where we actually added a functioning cash lag. And then we added a 2028 scenario, which basically differs from the 2026 scenario with adding scale. So that there's a sufficient threshold of volume of on-chain securities that are able to bring the costs down. And secondly, I already mentioned we were looking at domestic and foreign investors. We were looking at an 8-year corporate bond with a 50 million notional. We chose that simply because there was like an average corporate bond, average corporate bond in today's world. We were lucky to incorporate high quality data, starting with public pricing schedules, which can be also quite painful if you look at, price schedules, for example, of some of the players like Clearstream in the market that are not overly transparent, to put it mildly. And we also talked to a lot of industry experts that also resulted in concrete price points that we were able to use. And last but not least, we were able to incorporate high quality on-chain data from the colleagues at Cashlink. And what's also important is that we did a bottom-up analysis, meaning that we moved along the value chain of that corporate bond, and for each value chain element, we were analyzing the DLT impact on that specific part of the value chain. All right, now very important, the cost basis. And the numbers that you see here are numbers accumulated over the entire 8-year lifespan of the bond. So this is not like a per annum basis point analysis. So it spans across the entire 8-year spectrum. And what you see here, almost 60% of the costs stemming from the front office. And as I said before, we did not find any directly related, not any cost saving potential that were directly related to DLT in the front office. It's a different story when you move to the middle and back office, because there you can, for example, if you look at the trade flow monitoring part, that's where you instantly see the power and the effect of a single source of truth. When you're looking at a unified ledger, because you have vastly different, vastly reduced efforts, for example, for trade reconciliation, for dispute resolutions, because as I said, you simply are looking at a single ledger. And also on the back office side, for example, talking about clearing and settlement, which can vastly be reduced almost to nothing. And also when you look at the corporate actions, even more so, because that's one of the prime applicants to apply the power of smart contracts. All right, so this is basically the off-chain cost basis that we use to compare the corporate bond costs with an on-chain bond. All right, so if you look at the impact on the value chain, you can see, not surprising, low impact in the front office, and quite a high impact in the trade flow monitoring. The largest impact stemming from corporate action and asset servicing. Clearing and settlement, at least in the domestic scenario that we analyze, is percentage-wise very big, but it only makes like 1 basis point of the overall cost. So if you look at it from a overall cost impact in the domestic case, where you only have domestic investors buying and selling, that was not like a game changer. It's different for the foreign investor case, but not for the domestic case. And also interesting, if you look at regulatory reporting, for example, today, how do large asset managers and banks conduct their regulatory services? It's basically a push. You know, they're pushing messages in a certain format, in a certain way, in a certain sequence towards the regulator. And once you have this on-chain scenario, there's the potential for the regulator to actually be on the blockchain already, and you don't need to push it. It's rather like a pull mechanism. And yeah, I think if you look at on the right side of the slide, you also see that percentage-wise, and those are quite massive numbers. If you see, for example, trade flow monitoring, which I already mentioned, 48%. Depository business cut in half. Clearing and settlement virtually reduced to nothing, with the notion that it's that the overall pie is quite small here, and also very important, the corporate action part with 88%. You know, if you look at today's personal costs, like the HR costs that today's asset managers and banks are still conducting in their corporate actions for a bond, it's still absolutely substantial. You know, you have vast amounts of people that are still working there, and it's really hard to actually make further improvement and further automation improvements here, with when you're still moving only in the off-chain world. What's also very important and very interesting is when you look at the development of costs through time, or in other words, through the different levels of infrastructure maturity. Because, you know, if you compare today's on-chain costs with the off-chain costs, there's, as you can see here in the graph, there's nothing that's becoming cheaper. In the contrary, it's getting more expensive, and substantially so. And why is that the case? We found that first of all, the competition in the on-chain world is not as high yet as in the off-chain world. But the even more important effect is that today's on-chain markets, when you talk about ordinary security tokenization like bonds, stocks, and funds, it's just a fraction of the off-chain world. So you have a complete lack of scale today. And because of this lack of scale, you simply see this cost increase right now. And we have not even looked at IT costs here. You know, so this is just run-only standalone costs. You know, if you were to actually apply extra costs because of the fact that you have to run parallel IT systems for a while, you know, until there's a complete switch, and this will be many years until we have where we're going to see those parallel IT infrastructures. That you still have to add that up to that equation actually. And then on the right side, you see the 2028 scenario. We remember that's the scenario where we do not only incorporate a functioning cash lag, talking about delivery versus payment, atomic trades, but also the added scale. And with added scale, I do not mean like a complete switch. I mean, that's completely unrealistic in 2028, but at least a sufficient amount of volume in the market for the overall costs and marginal costs to come down. All right. So And we also did this analysis with the foreign investor case. I'm not going to go into detail here, but what you're going to see here is basically the same graphs in the middle and the right, with the only difference that the left graph is substantially higher. All right. So what are the main implications of the study? In our point of view, excuse me. In our point of view, you're going to have an incentive for companies to diversify. And what I mean with companies is asset managers and banks, to some extent also fintechs, to actually diversify their DLT product portfolio. Because if you look at the product portfolios today, you still have a large emphasis in rather revenue-driven products, which are represented largely by crypto trading, crypto custody. And with this, you have a stronger shift towards the cost side, so that you actually have cost-driven products where the consumer actually doesn't really care if it's on or off-chain, stock or bonds, but where the producer of the product very much cares, talking about the 7 to 15 basis points. And also in the IT operation side, if a company decides to do this, the company has to have a very, very clear picture of the amount of of the DLT capabilities it needs, and also the DLT IT building blocks that are necessary to actually deliver on those DLT capabilities. And you're going to have some tough decisions to make regarding sourcing. What you want to make inside your company, and what you want to buy from outside. And lastly, pricing distribution strategy. I think you have to look at this case individually, because some companies might want to incorporate those efficiency gains and savings potentials, and some others might want to pass it on either to their distribution channels or even to the end customers. So if you have any questions regarding this, if you want to know how we actually help our clients winning a DLT strategy in this regard, talk to us. We're more than happy to get in touch with you. Do we have time for a few questions?
If you want to, we can
start
take one or two. It's fine. Yeah.
Later.
Don't worry.
So if you want to, we can take 1 or 2 questions if you like.
Yes.
Sure.
Which concrete bonds did you analyze?
It was a plain vanilla corporate actions, corporate bonds, an 8-year maturity and 50 million notional.
Anyone else? Doesn't
Right.
seem to be the case. How do people reach you, either during or post conference?
I'd advise you to just look up my LinkedIn page, and also you can meet us at our company website at FinPlanet.
Awesome. Thanks. Dan, thanks for appearing on stage, and you're very interesting
All right.
talking.
Thank you very much.